when we talk about the dollar strength, we oftentimes associate it with the euro or British pound weakness, but I'm also seeing the Aussie dollar, the New Zealand dollar, and the peso are on low prints here. I mean, even the yen this week has been coming off. Clearly, the dollar remains king of the hill, Luke.
Yeah, thanks for having me back on, Ben. I think that's right. Clearly it does. And I think there's partly in response to an ironic set of circumstances. It's you've seen this funding squeeze, this dollar shortage that you really began to go critical back in March when you saw Fed funds rates above interest on excess reserves, or IOER, has continued to go critical. And so it's been very interesting to watch as yields have come down, the dollar has strengthened, and yet you've had, 4 really weak auctions in terms of bid to covers over the last 10 days or so.
Yeah, that's a good point that you bring that up. And the crazy thing, again, with rates coming off here in the U.S. to historic lows, the dollar still remains strong. And everybody that I have on the show, Luke, always points to and talks about how this is a direct reflection of the yield curve and rate differential that we're seeing. And again, that this could continue to play out for some time right now as central banks continue to lower.
I think that's right. I think ultimately it's going to come down to what the Fed does this week. Okay. And I think it's, an important context is, again, this dollar shortage globally has been pushing the dollar higher, but that's starting to visit U.S. shores vis-a-vis that Fed funds rate over IOER. And, to the extent the Fed doesn't want to lose control, so to speak, of the front end of the curve, they're going to need to start injecting significantly more amounts of dollar liquidity. And, so when, we thought that might begin to happen last month, and you had 2 important things happen. The first was the Fed only cut 25 basis points, not 50. And the second, and perhaps more important thing, was that Treasury came out and said that they're going to borrow $433 billion in just between July and September, which meant you were sucking almost $500 billion of dollar liquidity out of a dollar liquidity situation that was already pretty tight. So we saw the ripples in risk markets in the aftermath of that, and we sort of stabilized. And so I think all eyes look forward to what the Fed has to say going forward. And the bottom line is to us is that unless the Fed starts injecting significantly more amounts of dollar liquidity up to and including QE, which we think they'll probably have to do by the end of this year, early next year at the latest, then I think dollar continues rising, and I think eventually that ends up being bad news for risk assets again, like we saw a couple weeks ago.
Yeah, I think you're not alone in terms of that sentiment. Let's talk a little bit about how some of the focus in terms of the Fed and Jerome Powell has been certainly key this week, but I also noticed some comments from Boston Fed President Rosengren. Keep in mind, he was one of the 2 dissents last month in terms of the decision to cut rates, and it appears that he remains skeptic. He said this week we're likely to have a second half of the year that's much closer to 2% growth. He went on to say, I'm not saying that there are not circumstances in which I'd be willing to ease, but I just want to see evidence we're going into something that's more a slowdown. And he also said that just because other countries are weak, if we're strong, it doesn't necessarily mean that we should be easing as well. Is he right? I mean, if we're lowering because other economies are weak, is that a mistake, Luke?
I don't think it's a mistake. I think with respect to President Rosengren, part of this is our responsibility. We want to have the reserve currency of the world. Sometimes we have to act for other people, actually, number one. But I would encourage President Rosengren to talk to people in the money markets. The Fed's need to cut, in our view, and we've been writing this since late April, has been, this has nothing to do with the economy. This has nothing to do with inflation. This has everything to do with foreigners. The foreign central banks stopped buying treasuries 5 years ago. And then last fall, FX hedging markets began pricing such that FX hedge treasury yields went negative. And so it began to effectively pay the foreign private sector not to buy treasuries. And so what you're having is more and more of growing U.S. deficits having to be financed by the U.S. private sector, and it's crowding out money markets. And the money markets need the Fed to inject dollar liquidity to help them digest these deficits. And so, with respect, to President Rosengren, I would say, talk to someone in the money markets. He may think things look good right now. I assure him that if they don't cut enough and keep injecting the liquidity that the money markets are demanding, things are going to look very bad very quickly. You'll have, it is easy to get to a situation where you get something worse than 4Q18 last year.
Yeah, and Luke, it's not just money markets providing that conflicting opinion. You had Mary Daly, Mary Daly recently, yesterday, said that I should stress that my support for this cut is based around my desire to see our economic expansion continue, not because I'm seeing an impending downturn on the horizon. She went on to say, I don't think that we're headed towards a recession right now. She did say, when I look at the data coming in, I see solid domestic momentum that points to a continued economic expansion. She doesn't seem to be too concerned about it, that's for sure.
No, I think that's right, but I think it's critically important to note, the system that policymakers have created over the last 20 or 25 years is heavily dependent on equity prices rising, right? At 155% of GDP, U.S. equity market cap is effectively the U.S. economy, and we saw that in spades. If we remember, we had this sharp sell-off in 4Q18, and then we had January, February consumer data were the worst in 60 years in some cases. And as second quarter, as soon as we had a turnaround in equity prices in the first quarter, second quarter came in better than expected. And so, to me, there's sort of putting the cart before the horse a little bit. And by that, I mean, if money markets aren't addressed with liquidity, then you're going to see risk assets sell off sharply. And when you see them sell off sharply, then you're going to have all the excuse you need to be cutting rates aggressively. But the problem at that point is that the Fed will be even further behind the curve than they are right now.
Yeah, and again, with the Fed acting, as you mentioned, in terms of watching the market, in theory, that sort of supports some of the Fed put that we've been, conversation that we've been talking about. I want to get your last thoughts here, Luke, before we let you get out of here, in terms of what you think the most important thing to key in on today in terms of the minutes this afternoon.
I saw some on Twitter this morning, somebody talking about discussions of standing repo facilities and how far along the Fed is on that. And I think that's, I think that's brilliant. I think that's exactly right, because when you look at the standing repo facility, what it would amount to would effectively be the Fed monetizing deficits through, through the banks, and depending on the terms and how it is allowed to be dealt with, but. A standing repo facility coming sooner rather than later would conceivably be a very important indicator of significant liquidity coming. And, that's not something that markets, be they risk markets or currency markets or bond markets, are priced for at all.